Hi friends, my name is Krishna Akumalla. Welcome back to my YouTube channel. In our previous video, we discussed about the meaning of inventory, right? In today's video, we are going to discuss on significance of inventory valuation. Before we get into the inventory valuation. Yeah, anyway, inventory valuation has to be done separately. But why should I do the inventory valuation? What is the significance behind it? If I don't do it properly, what will happen? How it is going to impact on my financial statements? That is what we are going to discuss in this. So inventory valuation has a very important significance in our uh, financial statements. So let us focus on that in this video, and then we can get into basis of inventory valuation, methods of inventory valuation. Anyway, we are going to discuss about all those things later. Okay, so in this video we are going to discuss about the significance of inventory valuation. What is the importance of doing this inventory valuation? How this is going to be, having impact on our financial statements? That is what we are going to discuss on this video. Without wasting much time, let us get into the video. Okay? Okay, guys. In this video, we are going to talk about significance of inventory valuation. Let us get into the significance of inventory valuation. Why I need to do the significant, why I need to be careful about inventory valuation? What is the importance of inventory valuation? See, when we prepare the profit and loss account, trading and profit and loss account, how do we prepare it? When we prepare the trading and this is trading and the profit and loss account. Okay? How do we prepare trading account? We will bring in opening balance, to opening balance. This opening balance will be including raw materials, work in progress, and finished products. Similar way, we show sales. What is the finished goods? How much worth of finished goods we sold? And we will also show by closing balance. Closing balance also will have an raw materials, WIP, and finished product. And here we will have some direct expenditure. Direct expenditure which has relation to this production. But right now what you need to understand is, if the valuation of the inventory is not done properly, either in opening balance or in closing balance, it will have an impact on my profitability. It will have impact on my gross profit. Hence, I have to be very careful while doing valuation for the inventory. How that is going to have an impact, I will explain to you right now. Let me clean this up first. Okay, let us say I'm preparing trading and profit and loss account, trading and profit and loss account to opening balance. Okay, this includes raw material, work in progress, finished product, everything. Actual opening balance is 1 lakh. Okay, I valued this 90,000 by mistake, incorrectly valued. 1 lakh worth of inventory has been incorrectly valued at 90,000. That means what? Instead of 1 lakh, I showed 90,000. So this is debit side of the PN, trading and profit and loss account. This is credit side of the profit and loss account. Now what will happen? Here, 10,000 valuation short. That means what? My expenditure, opening inventory undervalued. If the opening inventory is undervalued, that means what? My expenditure is undervalued. My opening inventory is undervalued. If my opening inventory is undervalued with 10,000 rupees, what will happen? To that extent, my profit will increase. To that extent, my profit will increase. My profit will be overstated. Similar way, if my closing balance is supposed to be valued at 90,000, but I valued at 1 lakh, overvalued. I'm supposed to value at 90,000, but I incorrectly valued at 1 lakh. So what will happen? My closing inventory is overvalued. If my closing inventory is overvalued, what will happen? My credit side will be increased. My profit will have impact to that extent. My profit also will be overstated. My gross profit also will be overstated. So what I'm trying to say here is, if the inventory is not properly valued, either it can be a opening balance of inventory or closing balance of inventory. If these are not properly valued, that will have impact on our gross profit. That will have impact on our gross profit. This is one aspect. The second aspect of this is, you have cost of goods sold, right? We need to arrive the cost of goods sold. How do we arrive the cost of goods sold? What do you mean by cost of goods sold? Suppose if I sold 1000 worth of goods, this is units, number of units. 1000 units I sold for 1 lakh. 1000 worth of goods I sold for 1 lakh. How do I get to know what is the profit of selling this? How do I get to know the profit on this 1 lakh? That is the question. I need to arrive, right? If I sold 1000 worth of goods for 1 lakh, whether I got the profit or not, I need to understand, right? How do I understand the profit in this? If I know the cost of goods sold, if I know the cost of goods sold, that cost of goods sold, let us say if it is 90,000, if I reduce this 90,000 from 1 lakh, this 10,000 rupees is my gross margin, gross profit. How did I get this 10,000 gross margin, gross profit? Since I know the cost of goods sold, what did I do here? Goods sold worth of 1 lakh minus 90,000 worth of cost goods sold I reduced, and I got 10,000 profit. What is this profit? This profit is nothing but my gross profit. So if I want to know the gross profit of the goods sold, what I should have? I have to have the sales value, and I also should have the cost of goods sold. Are you clear so far? So you should know the cost of goods sold to arrive the gross margin, gross profit. How do I get to know the cost of goods? That is a point we need to understand now. How do I get to know the cost of goods sold? There is a formula for cost of goods sold. What is that formula? Cost of goods sold is equal to opening inventory. Whatever opening inventory is there, that plus direct expenses minus closing inventory is equal to cost of goods. For example, if I prepare trading and profit and loss account, to opening balance I will put here, to direct expenditure I will put here, because this trading and profit and loss account is a nominal account, all expenses and losses to be debited. So to opening balance I will put here, to direct expenses I will put here, by closing inventory, closing balance I will put here. So these two I have to add, and this has to be minused. Then I will get the cost of goods. How do I get the cost of goods sold? My opening balance plus my direct expenditure, which is debited in my trading and profit and loss account, minus my closing inventory, which is created in my trading profit and loss account. Then I will get the cost of goods sold. So what is the formula for cost of goods sold? Opening inventory plus direct expenditure minus closing inventory. What do you mean by direct expenditure? The direct expenditure which is incurred towards the producing for manufacturing the goods sold. Direct expenditure is the expenditure directly involved in producing the goods sold. So that expenditure we need to debit in trading and profit and loss account. Hence that has been debited here. So opening inventory plus direct expenditure minus closing inventory is called your cost of goods. If I know the cost of goods sold, what I can do? Sales minus my cost of goods sold is equal to my gross profit. Is equal to my gross profit. So now you see here, beauty. If I do incorrect valuation of my inventory, if I do the incorrect valuation of my inventory, what will happen? That will have impact on opening inventory. That will have impact on my closing inventory. then it will have impact on my gross profit also. That is what I was trying to tell you previously. So I have to do a proper valuation for my inventory. If I don't do that, it will have impact on my profitability. My profits will get impacted to that extent. Now you see here, when the closing inventory is overstated, if this is overstated, credit is overstated, my profit will increase. Simple. I'll show you with example how that profit will increase, because I'm keeping +1 +2 I mean to say 11th and 12th standard people in mind, and trying to explain how overstating of inventory will have an impact. Let us say opening balance is 10,000. Direct expenditure is 2,000. My sales is 20,000. My closing inventory is 6,000. Now what is the profit? 26,000. 26,000 minus 12,000 is equal to 14,000. This is my gross profit. This is my two gross profit. This is direct expenditure. So this is how I prepare the balance sheet. My opening inventory is 10,000. My closing inventory is 6,000. My direct expenditure is 2,000. My sales 20,000, and my gross profit is 14,000. This is a general trading and profit and loss account. This is how we prepare. Now, what I'm going to do is, instead of 6,000, I incorrectly valued with 10,000. I incorrectly valued with 10,000. That means what? 6,000 inventory has been valued at 10,000. That means my closing inventory is overstated. If my closing inventory is overstated, what will happen? See here, this total will change. This total will become 30,000. This total will become 30,000. If it is 30,000, 30 minus 12, how much? 18,000. 14,000 will become 18,000 profit. So just because I overstated my closing value, my profit has been increased from 14,000 to 18,000. 4,000 rupees profit got increased. Why 4,000 profit got increased? Because I overstated the closing balance, closing inventory. Since I overstated the closing inventory, that has direct impact on my gross margin, my gross profit. Are you clear so far? Next, when opening inventory is overstated, the net income for accounting period will be understated. See here, let us say my opening inventory is overstated. Instead of 10,000, I overstated this to 15,000. Let us assume that all others are correct. Instead of 10,000, I overstated my opening balance 15,000. Then what will happen? Now you see 30,000, 30,000 total, 15,000 plus 2,000, 17,000 minus 13,000. This profit will become 13,000. This profit will become 13,000. Why 18,000 profit has become 13,000? Because my opening inventory is overstated. My opening inventory is overstated. Instead of 10,000, I valued at 15,000. So since it is overstated, that has impact on my gross profit. My profit got reduced. My profit got reduced. See here, when the opening inventory is overstated, the net income for the accounting period will be understated. Automatically 18,000 profit has come down to 13,000. So if opening inventory is overstated, your profit will come down. If closing inventory is overstated, your profit will go up. Are you clear so far? Right. We'll go to the next point. Let us assume that all others are correct. Next point, what is saying, when closing inventory is understated. Let us say my closing inventory is 10,000, but what I did is, instead of 10,000, I valued this at 6,000. I valued this with 6,000. Then my total will become 26,000. 26,000. Then you see 15 plus 2, 17 minus this will become 9,000 profit. If my closing balance is understated, my profit will be reduced. My profit will be understated. Why profit is understated? Because I understated my closing balance. Since I understated my closing balance, my profit has come down. Are you clear so far? Right. Next. Now, next point. When opening inventory is understated, the income and accounting period will be overstated. Instead of 15,000, what I did is I considered this as 8,000. Understated. My opening balance should be 15,000, but I incorrectly valued at 8,000. Then what will happen? This is 26,000. This is 26,000 minus 10,000. My profit got increased. If the opening inventory is understated, your profit will go up. With examples, you can understand this. So what am I trying to say here is inventory valuation has a huge impact on your profitability. If you don't value your inventory properly, what will happen? Either your profit will be overstated or understated, depends on the opening balance or closing balance valuation. Are you getting my point? So you have to be very careful in terms of valuing the inventory. It has a huge impact on your profitability. I hope you are clear on this point. Next point, let me clear this. So the next one is inventory is having incorrect inventory valuation has impact only on income. Tell me, will that have impact only on profitability? No, it will have impact on your financial position also. How this will have impact on financial position? See, when I prepare the balance sheet, month end close or year end close or quarter end close, where am I showing this inventory? I'm showing this in current assets. I'm showing this as current asset. Suppose if current asset is overstated, value is shown more, it will have impact on my assets. If my inventory is understated, it will have impact on my assets. So that means it will have impact on my balance sheet. When I say if it has impact on my balance sheet, it will have impact on my financial position. What balance sheet will show? Balance sheet will tell us the financial position of the organization. Am I right? Balance sheet will tell us the financial position of the organization. If inventory is overstated, that means my balance sheet is not giving the correct financial position, true financial position. If the inventory is undervalued, my balance sheet is not giving the right, financial position, right picture to the, stakeholders. So your incorrect valuation of inventory will have impact not only in profit and loss account, it will have impact on balance sheet as well. Why it will have impact on balance sheet? Because this inventory will be shown as a current asset in the balance sheet by end of the month or end of the quarter or end of the year. Hence, the undervalue or overvalue of inventory will have impact on your financial position as well. Are you clear? Right. Next point. It will also have liquidity analysis. What is this liquidity analysis? For example, if somebody wanted to know the working capital, what is the formula for working capital? Current assets minus current liabilities is equal to your working capital. Current assets minus current liabilities is equal to your working capital. If current asset is overvalued, your working capital will be showing more, which is not correct. If the current assets are understated, it will have impact on your working capital because it is giving an incorrect picture of your working capital. So any organization, any financial institutions, any bankers, any customers, anybody for that matter, they would like to know the working capital of the business, working capital of the organization, right? How do I arrive the working capital? Working capital can be simply arrived by subtracting current assets minus current liabilities is equal to your working capital. If current assets are undervalued, it will have impact on working capital. If current assets are overvalued, then it will have impact on current, working capital. So either understating or overstating of your inventory will have impact on working capital as well. It will have impact on your liquid assets. Correct? So you have to be very careful in terms of valuing your inventory. Otherwise, it will have impact on your working capital. You have to be careful. Next, another important point is you also need to be careful while doing the uh, evaluation, inventory valuation, because as per statutory compliance, this is very important. As per statutory compliance, as per Schedule 3 to the Companies Act 2013, inventory valuation has to be done with a proper accounting policies. What are those accounting policies? How do we do the valuation? We have different methods of valuations agreed as per accounting standard. We are going to discuss all those things in our coming videos. There are some methods we need to follow in LIFO method or FIFO method or weighted average method. There are defined accounting policies to be followed to do the valuation that I am going to explain in coming videos. But if this valuation is not done as per the accounting policies, you are not compliant. You are not following the guidelines provided by the Companies Act. You are not following the guidelines provided by the Companies Act. That will be a non-compliant. So when you are running an organization, you have to be very careful in inventory valuation. Am I doing the inventory valuation as per the accounting standard specified? As per the accounting standard specified. If that is not being followed, if you are not following as per the accounting standards, what will happen? You will be treated as a non-compliant, right? So we have to, as per Companies Act, we should make sure that all my valuations are done properly. Clear? So your accounting policies adapted in measuring inventories, including the cost formula, should be properly followed. The total carrying account amount of inventories and its classifications appropriate to the enterprise. These are all to be followed as per the guidelines by the Companies Act. Very clear? So this is how, this is the significance of inventory valuation. You should be careful while doing the inventory valuation. Otherwise, it will have impact on your financial statements. I hope you understand the concept. And if you have any questions, please comment on my video. I'm very happy to answer your questions. Right? Thank you.